Here's a number almost nobody talks about, that one hedge fund manager used to beat the market by nearly 3 times over 17 years. It's not a secret algorithm. It's not insider information. It's a metric so simple, you can calculate it in your head. And most investors have never even heard of it. I've spent 50 years watching investors chase the wrong numbers. They memorize the P/E ratio. They quote it at dinner parties. And they completely miss what it's actually telling them. But there's a flip side to the P/E, a way of looking at the exact same data that suddenly makes everything click. It lets you compare a stock to a savings bond, to a rental property, to anything. And the man who built his whole strategy around it? He turned it into one of the most famous market-beating formulas ever published. Let me show you how it works. Let's start with what everyone knows. The price-to-earnings ratio. You take a company's stock price, divide it by its earnings per share, and you get a number. Say, 20. That means you're paying $20 for every $1 of annual profit. Fine. But here's the problem. That number, on its own, tells you almost nothing. Is 20 good? Is it expensive? Compared to what? A bond? A different stock? You can't tell. It's just a number floating in space. So let's flip it. If a P/E of 20 means you pay $20 per dollar of earnings, then flip the fraction. 1 divided by 20. That's 5%. And just like that, you've got the earnings yield. 5%. That's the return the business is earning for you, relative to the price you paid. Sound familiar? It should. Because now it looks exactly like the yield on a bond. And here's where it gets interesting. Once you see earnings as a yield, you can finally compare a stock to everything else in your financial life. Think about how you judge a savings account. You don't ask, what's the price-to-interest ratio? That's absurd. You ask, what's the yield? 3%? 4%? So why do we judge businesses differently? When you convert that P/E into an earnings yield, you can suddenly line stocks up against bonds, against real estate, against cash sitting in the bank. Let me give you a real example. In 1988, Warren Buffett made one of the most famous investments in history. He bought into Coca-Cola, eventually putting in over $1 billion. At the time, the market thought he'd lost his mind. Coke wasn't cheap by the usual measures. But Buffett wasn't looking at the price tag alone. He was looking at the earnings yield and comparing it to the alternative. He was asking a simple question. What return is this business handing me, year after year, for the price I'm paying today? And here's the kicker. A great business grows that yield over time. The bond pays you the same coupon forever. Coca-Cola raised its dividend and grew its profits decade after decade. That $1 billion stake? It grew into a position worth more than $25 billion. So the earnings yield isn't just a metric. It's a translator. It turns a confusing stock price into a number you can actually compare. But one investor took it further than anyone and built a formula around it. His name is Joel Greenblatt. A hedge fund manager who ran returns most people only dream about. In 2005, he wrote a small book called The Little Book That Beats the Market. And in it, he revealed something almost too simple to believe. He built what he called the magic formula. Just 2 ingredients. One of them was earnings yield, the cheapness of the business. The other was return on capital, how good the business is at making money. Buy cheap, good companies. Hold them. Repeat. Then he backtested it. From 1988 to 2004, 17 years. The formula returned roughly 30.8% per year. The S&P 500 over that same stretch? About 12.4%. Let that sink in. Nearly 3 times the market's return, using a metric you can calculate on a napkin. Now, a fair warning. Backtests are not promises. The real world is messier. Greenblatt himself said the formula goes through years where it badly underperforms, and that's exactly why most people abandon it. This is educational, not a recommendation. Always do your own research. And remember, past performance never guarantees future results. But the principle underneath it is timeless. And that brings us to the trap most investors fall into. Here's where you have to be careful. A high earnings yield looks tempting. A stock trading at 5 times earnings has a 20% earnings yield. 20%! Why wouldn't you buy it? Because sometimes, the market is right to be scared. A dirt cheap stock is often cheap for a reason. The business might be dying. The earnings might be a one-time fluke about to vanish. This is the classic value trap, and it's destroyed more amateur value investors than any crash ever did. Think of the newspaper companies in the early 2000s. Cheap on every metric. Huge earnings yields. And then, the internet quietly ate their entire business model. That's why Greenblatt didn't use earnings yield alone. He paired it with quality. Cheap and good. Because a high yield on a sinking ship is just a faster way to lose money. So the earnings yield gives you the question. But quality gives you the answer. Here's the one thing I want you to remember. Stop asking, what's the price? Start asking, what return is this business handing me for that price? Flip the PE, turn it into a yield. And then compare it to everything else you could do with your money. Because as Buffett put it, price is what you pay, value is what you get. The earnings yield is simply the bridge between the two. So let me ask you, when you look at a stock, do you check the PE, or do you flip it into a yield? Tell me in the comments, I read every one. And if this changed how you think about valuing a business, hit subscribe. We do this every single day. Tomorrow, we're tackling a metric Wall Street uses to hide debt in plain sight, and why it tripped up even seasoned investors. You won't want to miss it.